Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to your viewers from across the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blaire, and joining me on this Tuesday morning on the floor of the New York Stock Exchange for our market briefing and to weigh in on the top stories of the day is Tai Wong, independent proprietary trader. Tai, good morning to you.
Good morning, Remy.
Well, of course, as we woke up this morning, we heard about the latest from overseas, in particular the People's Bank of China, and their stimulus measures to shore up their markets and their economy. So what did you make of the headlines?
Absolutely. And I suppose you could call it a little bit of China's Big Bang, or at least I think China hopes it's the Big Bang. It was a big sort of press conference was announced relatively quickly. People's Bank of China running it, the securities regulator was there, and another top official was there as well. And let's take a look at what they did. It's the first day they said that the People's Bank of China has cut the reserve requirement and their 7-day rates on the same day, and this is a big deal because they don't typically do that. They also promised that the reserve requirement cut rate could be cut even more, and that means that banks can use more of the funds they have on hand to lend out. Now, a little side comment here is it's not that the banks don't have enough money to lend out, it's whether or not there's loan demand. So just making sure that it's a signal to the banks that you can release more capital, you can try to do more things with it. Whether there's demand for it is a different story. They also announced some big mortgage changes, and their property sector has been a big drag because it used to be the property sector was 25% of the economy or thereabouts, and you could argue whether or not real estate should be 25% of the economy. But whether you like it or not, a lot of people Chinese people citizens invested in homes and second homes, first homes and second homes, and all of a sudden some of these are underwater. Some of these haven't been delivered as places like, I think Evergrande failed. They couldn't deliver on apartments where they had received down payments, and it was one of those issues where they were taking down payments and paying current bills. So once that flywheel stopped, a lot of people paid money that they basically couldn't get back. So what did they do here with the mortgages? Now, just remember that all mortgages in China are adjustable rate mortgages. So they move up and down with the market. And as rates have risen over the past few years, that's hurt a little bit. And they're also maximum of 30 years. But there's also a little wrinkle to it where the age of the borrower plus the length of the mortgage cannot exceed 65 years. So if you're 45 years old, you can't get a 30-year mortgage. Their thinking is, well, you can't pay it because the sort of mandatory retirement age in China for men is 60. So given this, the People's Bank of China said, we're going to lower mortgage rates by 50 basis points. And that's going to put $21 billion US dollars back in the economy, or 150 billion yuan. It's great, but it's actually not that much. Just to give you an example, I worked out on my HP 12C. If you have a $300,000 mortgage and it moved 50 basis points, you would save about $90 a month, which is great for people who are struggling. If you have an extra $90 a month, you're probably going to spend it. You're not going to put it in the bank. So it will help them get to their goals of 5%. Finally, they talked about a stock stabilization fund to help support the stock market, which sounds great in principle, but virtually never works because it's artificial. And once those bullets are spent, stocks will go the way they go. Now, this is, and they've also done things to encourage the buying of second homes. The down payment went from 25 to 15%. That's sort of a lot better in terms of for those who want a second home. Now, this hurts the banks because now all of a sudden they make less money on their mortgages. So they've actually said we're going to add tier 1 capital to the banks to help them through the process because we're sort of impoverishing them from one side. We're going to add a little bit more money on the other side. And there's some other details with it, but it's a big package. and the stock markets loved it. Chinese and Hong Kong stock markets were up somewhere between 3 and 4%. I suspect they'll be up more during the course of the week. Their goal was, I think, the short term was to hit the 5% growth target, which they may well hit, or they'll miss it by a little bit. The question remains, though, is this going to be enough to really turn their economy around?
And Tai, I think you did an amazing job of breaking down the details of this package. And as you have highlighted, the economy does face challenges, especially when it comes to housing. So I do agree with you about whether or not this is going to really make a difference in the long run as well. And as you mentioned, we did see reaction in the Asian equity averages. And as we were mentioning yesterday, we were expecting this to happen in terms of an announcement from the PBOC before their holiday next week.
Right, right. And they didn't disappoint. I mean, they couldn't disappoint given how poorly the markets were faring and how bad consumer confidence was. So I think the monetary authorities threw out what they had there. But at the end of the day, to your question of whether or not this really turns everything around, is if you're worried about your job, if you're worried about the economy, and I say, hey, Remy, I'm going to give you 3.5% instead of a 4% mortgage, to buy a house in, let's pick a city, in Trenton, New Jersey. I just picked a city. You're like, but I don't want to buy a house in Trenton, New Jersey. Sorry, I didn't mean to offend anybody from New Jersey. It was just a town I picked. Trenton is the state capital of New Jersey. People have to want and have the confidence in their careers and in the future to want to buy a house. Because if you think about it in a funny way, when people take on debt, when people borrow money, it's really a sign of confidence in the future. I'm borrowing money because I think I can pay it back. So that's a really important part. They've got to rebuild that confidence, and that's a really tough ask.
And when we look at some of the headlines regarding the Chinese economy, we've talked about this with other guests that we've had on the show as well, but when you hear about youth unemployment, challenges in housing, as well as the struggles of the middle class there in China, and growth figures as well, that is really concerning. So you do bring back the point that whether stimulus measures such as these will really make a difference moving forward when it comes to the economy and, of course, growth.
I think this is a great first move. It's a good shot to the markets. I think the markets have probably have a little more way to run in terms of the fact that they like this package. But in the end, if this is it, I don't think it's going to be enough.
And we'll have to wait and see how this unfolds this week. But before moving away from central banks, Tai, so you were mentioning on the heels of the latest Fed official speakers, which included Bowman, who was the one dissenter last week when the other officials voted to cut by 50 basis points for the Federal Reserve. But you pointed that we're starting to see Fed fund futures when it comes to a 50 basis point cut at the November meeting creep higher. Is that correct?
Yes. Just late last week, the markets were pricing, the futures were pricing 25 basis points in November and 50 basis points in December. They're still pricing a total of 75 basis points, but now it's more centered by about a 55 to 45% edge, more 50 basis points in November than December. Now this is liable to change, but just the shifting of the thinking, as I guess the combined commentary from Kashkari and Bowman and Goolsbee is getting the market more comfortable that this Fed wants to cut. They think they have room to cut, and they want to get it in sort of earlier rather than later. So I think that's why the thinking is shifting a little bit. But we have a lot of data coming up. PCE on Friday will be the first one. If that comes in hot, I think that will probably switch back. They'll still think of a cut, but it'll be maybe 25 in November, 50 in December.
And it's hard to believe, but we are entering the final week of September, so that means the September jobs report is also coming around the corner, and that will be very closely watched.
Yeah, very important. Probably even more important than the PCE, because the Fed's saying, or has said recently, we're pretty confident in inflation, but we don't want the job market to deteriorate anymore. And as the professor said in a show yesterday, if you're getting 100,000 new entrants into the workforce every month, you need more than 100,000 new jobs to soak up those extra workers, otherwise your unemployment rate will start to grow up. Now, in some ways, this is a really good problem to have, that we have more people entering the workforce. A lot of developed countries have shrinking workforces, or looking at steeply shrinking workforces, particularly in East Asia. In China, in Japan, in Korea, it's become a big issue. So it's actually kind of a luxury.
And while we're on the topic of what's moving markets this morning, we've covered the PBOC and we've touched on the Fed, but we're also seeing commodities getting a boost this morning, aren't we, on the heels of the PBOC announcement? So I think, we've talked about gold and the record highs that gold has hit, but we're also seeing a move higher in crude today as well as some of the base metals.
Yes. So crude has had a pretty good run. I think it dipped a little bit when the new president of Iran, said that he wants to ease tensions with Israel, which is a little bit of a surprise, and which is typically not so good for crude. But the big stimulus package in China really boosted all commodities, including crude. Brent's higher this morning. WTI is higher this morning. Will it really last? Not until I think we see a real demand surge. I mean, this is the market trying to price in, well, it's a great move by the People's Bank of China. That means there's going to be more growth, and therefore there will be more need for energy and commodities. But markets do this; it happens all the time. But I would say that base metals, which I've traded for a long time, copper is at 2 months highs, up $225 a ton on the London Metal Exchange, and it's leading the entire network of base metals higher. And base metals in China uses probably around 50% of all the base metals that are produced every year. So whether they have great demand will directly lead to how these metals do. When China was looking a little bit better at the beginning of the year and there were a lot of supply issues, copper went over $10,000. And then it relatively rapidly fell back to 9,000, and now we're at 97, 9,800 because of China. I think it's probably, it may extend a little further, but I don't know if there's enough yet to put base metals into a sharp uptrend higher.
And so, Tai, you've been in base metals for a long time, so you understand what moves that sector of the market. But why is copper seen as an indicator of economic growth or a fall in demand?
So copper is a sort of a great conductor. I mean, the precious metals are better conductors, but they're a lot more expensive. Right? In the U.S., it's traded in cents per pound, and it's $4.50 a pound. Whereas silver's a great conductor, but that's $30 an ounce. And gold's an even better conductor, but that's $2,630 and rising. So copper is really the metal that you need for you need for electric cars. You need to put in wiring, sometimes piping if you have a really nice house. So copper is used in so many industries for critical things, and it's hard to get a conductor like copper that anywhere near that price. So that's why copper is so important. And concerns about it are the existing copper mines are producing, but we don't have a lot of new copper mines down the pipe. Nothing, to start a mine, to get it from sort of soup to nuts where it's producing, that's a 10-year issue, and there's not a lot of things in the pipeline. So the view is, if growth continues the way that we think it's going to continue in EVs or in other things, then we're going to run out of copper. But there are a couple of things to be careful there. Is if growth continues like we assumed, and we can always kind of get more supply as copper gets more expensive, people recycle more. So it'll be an interesting market, but it's always a good market to see where China impacts that market in a big, big way.
And I do want to take a very quick look at the markets right now, because earlier this morning we got the release of the Consumer Confidence Index from the Conference Board, and that declined in the latest month. It came in at 98.7, and that was much below the 105.8 seen in the previous month and lower than expected. So initially after that release at 10 a.m. Eastern Time, we saw the major stock averages fall below flat, but the Dow Jones Industrial Average is still holding on to session gains and is higher by nearly 0.3% or over 100 points. And this does come on the heels of yesterday's record close, Tai. So it'll be exciting to see where the Dow actually ends up at the close of today's session. Meanwhile, the Nasdaq Composite Index is flat in mid-morning trade here at the New York Stock Exchange, while the S&P 500 is also flat, just barely above the flat line this morning. So we'll keep an eye on what happens as we head into the rest of the session. So what's that I noticed this morning coming in is, despite the rally in Asian equities, the move in commodities, as we touched upon the base metals, crude oil, as well as gold, is that crypto hasn't really moved that much compared to where it was yesterday. So what do you make of some of the moves that we've been seeing in the crypto majors?
So crypto has had a nice bounce behind the risk assets bounce and behind the Fed's cut last week. I think it's looking for another signal, whether it's a weak employment report, in a week and a half's time, or a low PCE to get a little more confidence. It bounced from relative lows. It's had a nice run. I remain concerned that Bitcoin's trying to break out of a downtrend, and it's just nosed above it. So I think right now the price action is going to be a little sideways. People who bought at 70,000 in Bitcoin saw it drop below 60,000. At 63, 64,000, they may be thinking, well, maybe we need to pare back our exposure a little bit, or certainly we don't want to be buying more here until we get perhaps another signal. I think it just needs another little boost of energy, and we're waiting to see what that is.
Yeah, it's very interesting because there were expectations possibly that it would move based on what we heard from the PBOC, but we did talk about the relationship of Bitcoin and fundamentals in the previous session. So it's interesting to keep an eye on those relationships.
Yes, definitely.
And of course, while we're watching markets this morning, we're seeing Boeing shares lead some of the Dow laggards this morning. Boeing is off by 1%, and we are watching the headlines and what will transpire regarding their latest offer. So what do you think is going to happen here, Tai?
So there's an interesting interplay here. So Boeing comes out and says, this is our best and final offer. Which is sort of interesting. It's an interesting negotiating point. And I mean, it's a pretty good offer. Instead of 25% raise over 4 years, they went to 30%. So that means on average, well, this is according to Boeing, but I'm going to assume that their data is correct, that the average annual pay for a machinist will move from 76,000 today to 111,000 at the end of the 4 years. Now that's pretty good. Once again, I'd like to have that too, just saying.
That's quite an increase.
That's quite an increase. They are also restoring the annual bonuses that they had lost, which was a big point of contention. They are doubling the signing bonus from 3,000 to 6,000, and for people who middle class sort of families, if you get an extra $6,000 ahead of the holidays, that's pretty good. So I think that's certainly a little carrot there, and then they're going to increase their contributions to their 401k as well. So what's interesting is the union, which had agreed to the 25% pay increase earlier, said, no, you didn't consult us first. So we don't like this. And the other deadline that Boeing said is this deal is, I guess, an exploding deal, which says you have to vote to ratify by this Friday. And the union feels a little usurped, although it is clearly a much better deal than, a significantly better deal, I should say, than what they had before. So will they ratify it by Friday? Probably not. There's probably a little room there because Boeing doesn't want this to drag on any longer. It remains to be seen whether this is enough. And one thing is that if you say it's your best and final offer, well, it better be your best and final offer, because if it isn't, then you'll say, well, it's always your best and final offer. We'll just hold out for a little longer. Let's see if we can do that. So I think the market is uncertain about this ploy, which is why Boeing shares are down this morning.
And you and I have talked about Boeing in the past few trading sessions. We've seen the price action for that stock go up as well as down. And when we think about it, with each passing day without an agreement, we know that Boeing is losing tens of millions of dollars. So that is concerning. And of course, earlier this morning, you and I were talking, apparently Ryanair was saying that Boeing expects disruptions 2 to 3 weeks beyond the end of a strike, and we still don't have any timeline or expectation of when that strike might end.
That's right. It takes, everybody puts down their tools. You probably take a while. It takes a little while to get everything going again. And I think they have a singular focus on making sure everything is working well and on quality, given their, the recent troubles over the past few years, which is really, kneecap what was once, if it ain't Boeing, I ain't going, a motto that they used to be so proud of. And I think that they're going to tuck that one away for another decade or so before, before they get their quality back up to speed. So it's going to take some time. The estimates are as much as $100 million a day. So, that hurts. And that hurts in terms of your potential ratings downgrade. The 2 or 3 weeks were what some of the ratings agencies said before they might have to downgrade Boeing, and they're only one step above junk status. So it's right now they want to get everything going, but it's the sooner they get it over, the better. So it's it'll be interesting to see if this ploy works.
And I'm sure heading into the rest of this week, we'll continue to monitor headlines on Boeing and if there's any progress made regarding the strike. So before we move on, I do want to talk about what's happening here in the city. So the UN General Assembly taking place, a lot of gridlock, a lot of traffic around Midtown Manhattan, especially around the UN, given that heads of state are here. So we're keeping an eye on what's happening in the Middle East, and of course Biden is expected to speak at the UN as well, at the General Assembly, but apparently Iran's president wants to ease tensions with Israel. So it'll be interesting to hear him speak as well today, but what do you expect?
So I don't think expectations can be too high, because the political apparatus in Tehran is really the real center of power are the Ayatollahs. And the president of Iran, you'd say, oh, he's a reformist or he's a hardliner. I remember a few years ago when Ahmadinejad came and he was a hardliner and he had, some infamous comments. But the range in sort of the political apparatus in Iran, it's about this wide, right? So, a reformer might be here and the hardliner might be there. But it's an interesting signal that you shouldn't ignore, because if Iran decides for whatever reason they want to take the heat off, maybe they think they can get some sanctions relief, and that they can probably, I don't think they control Hezbollah on a day-to-day basis, but they're Hezbollah's financier. They are the main supporters of Hezbollah and Hamas. If they tell Hezbollah, all right, you've taken a hit, you've hit back, you can walk away with honor. Let's dial the temperature down so you only shoot 10 missiles a day or whatever it is. There'll be impact to those statements. So definitely listen to what he's got to say, what Netanyahu's got to say. Actually, I'm interested to see how the UN responds to him, and then also what President Biden has to say. But it'll be an interesting week in New York for sure.
Yeah, absolutely. I'm sure we will be talking about what comes out from the today's session at the UN. But as you mentioned, there are so many moving parts here, and the U.S. sent more troops yesterday to the Middle East. So this is concerning from a geopolitical as well as a political standpoint, isn't it?
Right, and I think they moved the carrier Harry Truman closer to the Eastern Mediterranean, just to make sure that if something gets out of hand, we have eyes and ears and are able to project our power. As quickly as possible, just in case. And it's really a signal. We don't like to put troops in anywhere, particularly, and we're not going to, in Lebanon, since we had a little problem in Lebanon back in 1982. So a lot of things to watch this week.
A lot to watch from the geopolitical front as well as political front, and as we approach the vice presidential debate coming up the beginning of October, I'm sure this is something both candidates will be addressing.
The last sprint to the finish in this unbelievably close election.
Okay, Tai, well, as always, thank you so much for joining me here on the floor of the New York Stock Exchange. to go over the headlines affecting the marketplace.
Always good to be here.
Thank you, Tai. And coming up next, we will be joined by Larry Raiman, REIT expert at LDR Capital. We'll be right back. Don't go away. Welcome back to Global Money Talk live from the New York Stock Exchange. The Federal Reserve voted to cut the Fed funds rate by 50 basis points at the end of its September meeting, while updated projections indicate another 50 basis point cut by the year end, with total cuts reaching about 100 basis points through 2025. The forward guidance does give markets a clearer outlook on future cuts, providing certainty for investors. So will the commercial real estate industry in the U.S. see a turnaround in terms of transaction volume on the heels of the Fed's latest move? The Fed will also continue quantitative tightening. While joining me here for today's market insight on commercial real estate is Larry Raiman, REIT expert at LDR Capital. So thank you so much for joining me.
Very nice to see you today.
Well, you're joining me at the end of the third quarter, about to head into the final quarter of this year. So I do want to hear about the landscape for commercial real estate as it stands, especially on the heels of the latest Fed rate announcement.
Sure. So commercial real estate is so important because it is the fourth largest asset class in the country, behind the equities market, behind the residential real estate market, and behind the U.S. Treasury market. Backing commercial real estate are $6 trillion of commercial loans. And those loans are very interesting because they are very different than residential mortgage loans. Someone buys a house in the United States, they generally get a long-term fixed rate mortgage, 10, 20, 30-year mortgage, fixed rate, and as part of the monthly interest payment, they will also amortize down or pay down that mortgage balance. The commercial mortgage market is very different in that these are generally shorter term mortgages, 3, 4, 5, or 6 years, all interest only, with no amortization or pay down of the principal balance over the short term, which means that a landlord will pay interest for 3 or 4 or 5 years and then have a balloon payment to pay off the entirety of the loan at the back end when it matures. Well, the $6 trillion mortgage market, about a third of it will come due in the next 3 years. So close to $2 trillion of mortgages and loans will come due this year, 2025, and 2026. And what's happened in the marketplace, because in 2022 the Federal Reserve raised interest rates so high, that had an adverse impact on commercial real estate values. So the loans to value, which were originally 60% of value for commercial mortgages, rose to 60, 70, 80, 90%, if not 100% of value. So now you have a dialogue going on between landlords and lenders, where the lenders say, we gave you a loan, it was 60% of the value of the office building or the shopping center. Well, that's now 80 or 90%. You need to cure me because you are in default on your mortgage. So one of three things can happen. A landlord can say, no, here are the keys to the property, you deal with it. It could say, sure, I've got cash in the bank, I'll pay down the loan and get you back in compliance. Or the landlord can say, let's talk, let's negotiate, let's figure it out. And all three of those doors are being entered depending upon the type of property, depending upon the location and the market. And the predominant share of assets are being negotiated. I'll give you a quick example. A friend of mine is one of the largest landlords of industrial buildings across the country. He has a property that he got a call from his lender to say, your loan is way too high now relative to the value of the building. My friend said, the building's full, the parking lot's clean, the roof is good, the tenant is happy, it's fully occupied. What else can I do as a landlord? And the lender said, all right, let's talk. Let's figure it out. Give us some dollars, we'll extend the loan, we'll kick the can down the road, and that's great. Where the problem resides is where the landlord says, I don't want to own the asset anymore. It's a tired office building, it's an old apartment building, it's a hospital where the hospital chain is no longer operating. We don't want it anymore. And that's where the defaults will occur, which create both risk and opportunity in the marketplace.
And so, Larry, you just mentioned the different options, the different negotiations that are taking place. And in this post-pandemic environment, if it does come to that last option, walk us through what actually happens there.
So in the event of a disconnect between the landlord and the lender, where the property is not desired anymore by the landlord, the bank, which is 50% of the lending market, or the life insurance company, or the securities market in the hedge fund world will take the asset over and they'll have to do something with the asset. Now, if the asset is a good quality location but an old asset, they may put some money into it and re-merchandise it. Take an office building and make it an apartment house. Take an office building and make it a high-rise industrial building. Take a regional mall and make it into a multifamily residential community. Or if there is no value for the product, raise the property and you buy it for land value and then figure out what to do with it. So in all cases, it really comes down to what's the location of the piece of real estate that is in default, and is there a remerchandising, a renovation, a recalibration of it to make it useful again.
And Larry, I think you've walked us through some examples, and you're highlighting both the opportunities as well as the risks out there when it comes to the current environment. And as we continue to move forward through this Fed rate cycle, we'll see what this means for the commercial real estate sector. But can you also walk us through the different types of product out there right now that you're keeping your eyes on?
Sure. So the commercial real estate marketplace is broad, and there's a large spectrum of different types of properties. There's the traditional 4 food groups. There's office, industrial, multifamily properties, as well as retail shopping centers. But then there's all kinds of other properties as well. Hotels, hospitals, self-storage facilities, data centers, towers, and on and on and on. When you look at the commercial real estate pie, about 20% of it is commercial office. The remaining 80% are these other categories. In the public marketplace for real estate investment trusts, only 3% of the market capitalization is office. The remaining 97% are other product categories. And what you're finding in today's world is, while there are stresses and strains in the office market, if you like, we can chat about it, the other property categories are doing very well. If you own an industrial building today, you're getting rent growth, your building is full because of online retailing. If you look at the apartment marketplace, where we are underserved from a housing perspective in this country, and for sale housing is quite expensive today, unfortunately, for many folks who want to buy a home, people are renting for longer, which means rents are going up and occupancies are full. And when you go through many of the different property sectors, the data center sector is a $6 billion sector, and it's supposed to be $21 billion in the next 10 years. We're consuming demand, we're consuming data, we're consuming broadband, and that's only going to grow. So in many of the property sectors, the operating results are quite fine. And it's a matter of the one kind of area that is a sore thumb in commercial real estate now, which will be for a period of time, is the office marketplace, which is challenged and likely to be challenged.
Of course, and I think you helped us understand what the categories are when we're talking about commercial real estate. And as you mentioned, throughout the pandemic years, we've seen a shift when it comes to how people commute, whether they work from home, and in this current environment, we're hearing about companies demanding their workers return to the office. So I do want to zoom into the office before we take a look at the other product categories, because as you mentioned, when it comes to data centers, there is a lot of demand, especially given the rise in demand for AI. So we know what that means. But first and foremost, when it comes to office, we know that here in New York City, even down on Wall Street, outside the New York Stock Exchange, it isn't what it used to be. So break it down for us when it comes to different regions throughout the country for office space.
Sure. So there's overall in the country about 1 billion square feet of office across the country. New York being the largest office market, but substantial office markets in Boston, Chicago, the main San Francisco, Los Angeles, Miami, Dallas, Houston, some of the main metro markets. And what we're finding is the nationwide office market has risen in vacancy to 20%. And when you look at that broad nationwide, we'll get to individual markets in a second, is you need about an 80% occupancy rate to break even, because of the engineering costs, the staffing costs, the tenant concession costs, the renovation costs. To keep a building current, you need an occupancy rate of 80%. Well, with vacancy rates of 20%, a lot of landlords are just breaking even in their office investments. And what's happened is when you lift the hood up and look one level deeper, you find that some markets across the country are doing quite well, like as an example, Park Avenue. If here in New York City, if you go from Grand Central to 59th Street on Park Avenue, rents are $250 a square foot and you can't find space. But if you go 2 or 3 avenues over, or 2 or 3 avenues over east or west, you find landlords are giving space away. And what's happening not only just in New York, but also in Chicago and in San Francisco, which is a distressed office market, Los Angeles, a distressed office market, you find slices of the market in severe distress, and then you have other parts of the market which are actually quite strong. So West LA as an example, quite strong. Downtown LA, very, very weak. And the same thing is in the case of Miami and Chicago. So in the office market, no matter where you are across the country, the key is that there is a dispersion of operating performance and demand within each of those markets, where there are slices that are extraordinarily in demand. In fact, there's probably more demand than supply, and in other markets, there's no bid for that space. And the challenge for landlords is to focus your investments on those slices of the market that are in demand. And if you have an asset that is elderly, that the market's moved on it, maybe raise it and build an apartment building out of it, or take it into an industrial building, or find some other alternative use. And that will get the office market, which is so much available space, into an equation where the supply is back in sync with demand. That's going to be a 10-year cycle.
Yeah, I think it's very helpful to learn about this and see what's happening across the country, because we read about the headlines, the news about certain areas of the country that are experiencing distress when it comes to office space, and when it comes to building owners choosing to walk away from their properties due to some of the challenges out there. Tell us why this is happening.
Well, it's happening because at the end of the day, they don't have the capital to reinvest in their property, or they don't have the long-term vision for the property. And the lender is basically putting the screws to the landlord to say, pay us back. And the landlord saying, no, we don't want this asset anymore. Now, it comes with particular pain, because oftentimes landlords have depreciated their asset, which means their basis is reduced. So if they turn back the keys to the property that they owned to a lender, they might have deferred capital gains that they'll have to pay taxes on. So oftentimes when a landlord turns a key back, it doesn't come for nothing. It comes with a cost, and that is embedded taxable loss or gain that they have to pay back to federal government in taxes, and they've lost their equity as well. So ultimately, when an asset is given back, it really has to be a severely impaired asset where the landlord says, even though I have to pay money to give the keys back to my lender, I'm still going to do it, because that means I'm going to lose even more money by owning the asset. So what that means for the person who eventually takes over, the institution that takes over the asset, is they need to get it at a very low basis, because by definition there's deferred maintenance, there's embedded costs to the asset, maybe there's taxes to pay to the municipality that have not been paid for many years, there's tenant concessions that have to be given. So all of those embedded costs have to be borne by the new owner, which means the owner is going to want to price that asset at a very low level. And that's a very hard discussion to have, but right now that's underway in many assets.
Absolutely, it is indeed a difficult conversation to have, but it does fit into the overall accounting equation. And before we move away from the office sector when it comes to commercial real estate, I do want to ask you what's really happening in terms of the badge swipes into office buildings, this trend of working from home. Do you think this is going to make a difference with more employees working away from home and back in the office place?
Very much so. We are in a secular decline for office space. Because of technology today, we can work remotely as easily as work in the office. Now, we lose the collegiality and the communal nature of conversation. That the interpersonal conversation is more valuable than anything. But people want to have flexibility in their lives. So what that means is there has been a secular shift away from the utility for commercial office space, which is why vacancy rates have risen to 20% and may even rise higher. So what that means is we need to have less supply. It means that people will want to work from home more frequently, maybe Mondays and Fridays, and work in the office Tuesday, Wednesday, Thursday. And at the end of the day, it's going to be a conversation between employers and employees as to what the right balance is between the two. I mean, certainly working in the office is very important for younger employees to learn from their more seasoned counterparts and how to manage their business, how to manage their career, and how to progress within their career. You can't get that remotely. But at the same point, people want flexibility. They want to be able to work remotely. And that's where we are now finding our way in the office utility space. It's kind of similar. There's an analogy with the regional mall business of many, many years ago. Where there were 1,600 malls many years ago, and then what happened? We started shopping online. And now the utility of bricks and mortar retailing has gone down. So what's happened? We now have 1,100 malls, not 1,500 or 1,600 malls. We've de-malled 500 malls in this country, and it's probably going to be less than 1,000 soon. So the amount of supply of malls has reduced to meet the lower level of demand for going to a store and shopping. We're now doing it online. The same analogy is holding true for the office space. We're not going to the office as much. We're working from home a little bit more. We're creating a better balance between work and life. And that requires less office space, and it's going to be a similar decade's worth of rationalization of this office space to meet the current run rate, if you will, of people working in the office and out of the office. And that'll continue for a while.
Yes, I think that's a great analogy for us to refer to, because we think about the advent of online shopping and e-commerce, and before we had that, we actually had to walk, drive, commute to the shopping mall,
Yes.
and to actually do our shopping,
Yes.
instead of pulling out our smartphones and
Yep.
placing all these orders online.
Tremendously so, and that's changed, and now this is the new reality. It was a secular shift in the manner in which we shop. Now, we still like to go to stores, touch and feel, look at the different inventory, speak to a sales representative and fare what's best for me. Great. There's a place for bricks and mortar retail. It wasn't what it once was. Same holds true in office. There's a place for office work where we can speak, we can talk. You and I are speaking now. It's a much better conversation in person than it would be electronically, which is wonderful, and thank you for this.
Of course, thank you, Larry.
And that's the case. And so there's a place for office space, but less so. And that's what we're now living through. And that displaces valuations, it displaces a lot the lending market, and it'll be good, it'll be ironed out. And that's what creates opportunity and risk in the market. There'll be some very crafty landlords and hedge funds and entrepreneurial real estate managers that see an office building that's underutilized and say, you know what, I can change that. I can change the merchandise mix of that building and get real value out of it. Put a supermarket in the basement. Put a healthcare facility on the third floor, whatever the case may be, and get greater utility out of that bricks and mortar where we can no longer get it in more traditional office space.
Well, absolutely, Larry, and I'm interested to see what comes out of all of this, especially in a city like New York City, although there are zoning complications with some of the buildings, but of course it'll be exciting to see what comes out of this. And speaking of opportunities, I do want to take a look at life science hubs across the country, because the United States is such a big country, and we have different regions, and different cities are seen as life science hubs. But I understand there has been a decline in demand, especially as we head further into 2024. So what's going on there?
So it's a very interesting subcategory of office. It's essentially a specialized office composition. And we've seen, up until over the last really 2 years, tremendous growth. Venture capital funding for biotech and for emerging healthcare providers. And that drove a life sciences office market to a great degree. And the reason why it is a subcategory of office is that the type of square footage and footprint of a life science building is very different than a traditional office. With a traditional office footprint with maybe a bulk common area, in the life sciences space you need lab work. You need medical practitioners doing testing and programming. So it's a much higher finish, whereas a traditional office building may cost $300 to $400 a square foot to provide really good finish and environment for a traditional office worker. It may be $1,000 a square foot for a life sciences building. And with the venture capital market drying up to a great degree, a lot of the small and emergent healthcare and biotech and new healthcare technology companies have lost capital provisions to build and grow and occupy more space. That came at a time where there was a tremendous glut of new development. So right now in the marketplace, occupancies were at 1.97% across the life sciences area. Now that's fallen by close to 10 percentage points. So now you have much more space available, and you have a lot of new space coming online, and there's discussions about probably a 4 or 5 year glut of excess supply in the life sciences market. So we personally believe over the short term there is risk in that market where operating fundamentals will be a bit challenged. If you can look through the next several years, there will be a long-term demand for the space as we continue to grow our need and necessity for greater and greater medical technologies. So we are bullish on life sciences over the long run. we're a bit less bullish over the short term while we get through this supply gut.
And Larry, now that we've covered the office sector when it comes to commercial real estate, I think it'd be helpful for the viewing audience to learn a little bit about the main categories of REITs when it comes to equity, mortgage, hybrid REITs. Can you explain the different types of REITs?
Sure. There are essentially two basic types of REITs. One are equity REITs that own all the traditional equity real estate, office, industrial, shopping centers, apartment buildings, hospitals, hotels, self-storage facilities, and data centers, and on and on. And then there are mortgage REITs. Mortgage REITs provide loans to users, whether residential, in the residential market, they're called residential mortgage REITs, or in the commercial market, commercial mortgage REITs that put mortgages on commercial office buildings and other commercial real estate. And the overall public real estate market is over $1 trillion of market capitalization, and only 3% of it is the office market. The remaining 97% are these alternative categories. And we do cover all of those areas by having management meetings and company visits and listening to their earnings calls. And by and large, what we found is that the pandemic caused some of those companies to have a stoppage. The shopping center companies, a lot of the retailers, closed their doors temporarily. The hospital chains, people couldn't visit their loved ones in hospitals, so there was difficulty having entrance into the hospital chains. Certainly the hotel sector was shut down while there was a nationwide ban on travel. So since that time, there has been a recovery in most of those property areas where things have come back into good standing. And the one area that has lived through a very consistent growth is the industrial marketplace. When we were sitting in our homes and our apartments and we unfortunately were quarantined, we were shopping online and we were getting goods sent to our houses. So the industrial market remained really tight during that period of time. The other market that remained very tight is the apartment market, because single family houses are still very expensive and people are renting more and more for longer and longer. And the market's been considerably tight for a period of time. So both of those areas are 96–97% occupied with continuous rent growth. Those two areas remain pretty stable and steady all through the while, where some of the other markets have had a bit of a rockier path, but now getting back towards resiliency.
And you brought up the demand for industrial space, especially during the pandemic. And as you mentioned, we're all sitting at home and we did have the convenience of shopping online. But I remember hearing about how drones are being utilized for people who wanted to take a look at industrial spaces, but go sight unseen to see if those spaces would be suitable for them. So I think it really does speak to how technology was maximized during that period. And as you mentioned, demand for data centers. So before I get to that, I very quickly want to ask you about the differences between publicly traded, public non-traded, and private REITs, especially since we're here at the New York Stock Exchange.
Sure. So we focus on the public real estate market called the Real Estate Investment Trust area. And there are differences and similarities between the public real estate market and the private real estate market. A similarity is they own similar assets, commercial real estate. The underlying collateral is similar, although in the private market it's much more heavily weighted to the office market than in the public market, which is very minority exposure to the office market. But generally speaking, the collateral is commercial real estate, collecting net rents and paying it out to investors, whether in a private structure or a public structure. But that's where the similarity ends. The difference is in the private market, a private market where you and I to go buy a commercial property, whatever it may be, we'd put some cash down and we'd get a mortgage and we'd finance that asset as an asset. The public market has pooled financing, where they will pool finance their entire portfolio of assets as a collection rather than individual assets. And the leverage levels of the public companies are only about 35%, versus in the private market, leverage levels of 2/3, if not higher. So in the public market, with a 35% leverage level, that means 2/3 of their assets they own free and clear. So if they have a hard conversation with a lender, hey, by the way, we gave you a loan and now the loan to value is a bit too high, well, we can go as a public company and tap the capital in unencumbered assets that we own free and clear, get a small mortgage on that, and repay the lender, and that way we can pool finance our assets. So, and also the public companies have, by definition, we're here sitting in the New York Stock Exchange, access to public capital. There's 2 companies doing public equity offerings today. They can raise public debt, they can raise preferred stock. So this year alone, the public REITs have raised almost $50 billion of capital. That creates tremendous liquidity, and they're able to do it because they have low leverage, there's transparency, there's governance of the public companies. So by and large, the public companies don't have the stresses and strains of what's happening in the private marketplace right now because of their access to public markets and the manner in which they structure themselves.
And Larry, I think that was a very helpful overview of what's happening, but I do want to very quickly get to data centers. So here we are at the New York Stock Exchange, as you mentioned, and everything hinges on data. But to be able to access that data, to store it, to process it, we need data centers. So tell us what's happening when it comes to that area of real estate.
Tremendous growth, simply stated. The nature of data centers is a couple-fold. These are bricks and mortar pieces of real estate, but they're located on energy hubs where they can tap into energy hubs, and with high finish, you need to have certain temperature control. So all of this, so it's a very high finish, specialized building that can deliver energy real time to the New York Stock Exchange, to high broadband users. And by and large, it's a very in-demand area that is continuing to grow, particularly in metro markets like Phoenix, which has robust growth, and Miami, San Francisco, LA. So the major markets where you have tremendous demographic growth, we're seeing huge demand of data and broadband capability and requirements that needs to be delivered. So the marketplace is going to see asset growth, both in the form of asset value accretion, but also new assets delivered to the market. So there's going to be a tripling of data center value in this country over the next 10 years, simply because of the value growth and the increased demand for space. And that's not going to change, and most of the new space will be developed. Very difficult changing an office building and make it a data center. The finish won't be good enough. It won't be located where there's an energy hub to deliver the broadband energy for AI or for 5G or maybe even 6 or 7G down the road. So it has to be a particular location with a particular type of building delivered close to a metro market where the consumption of this broadband is so prominent.
And Larry, we have about less than 2 minutes here, so before I let you go, building on what you just said, where do you see the opportunities in the CRE space right now?
So opportunities span the horizon. If you're an entrepreneurial real estate entity, you could buy an older office building and turn it into a newer office building. Or you could take an older office building at a very low basis and turn it into a high-rise apartment house. You could take a cash-flowing, long-term leased property, because interest rates are higher. You could buy a long-term lease, own it passively, and get a very high yield on your cost, and have that in excess of your cost of capital. So the span of opportunity ranges based on the asset type. We are structurally underhoused in our country, so apartment houses and multifamily communities will be, in our view, full for a long period of time, which generates demand for higher rents and cash flow over time, which is wonderful. So the opportunities are very specific to the property market and the location. I would say if you put it on the spectrum, You could have entrepreneurial upside and opportunity within the office space, given the dislocation occurring. You could have consistent return on investment in some consistent markets, such as industrial or apartment houses or community centers. And you could have very stable income oriented from long-term leased real estate for 20 years.
Okay, Larry, well, thank you so much for such an interesting conversation into commercial real estate. I appreciate all of your insights today.
Thank you so much.
Thank you. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us, and we'll see you back here tomorrow. Have a great day.